Hey there! Welcome back to our channel. Today we're breaking down value investing, a powerful way to grow your money that doesn't require a finance degree to understand. If you're looking to make smart investments without getting lost in financial jargon, stick around. Alright, so what is value investing? In simple terms, it's like shopping during a big sale. Imagine you find a brand new phone that usually costs $800, but it's on sale for $500. You know it's worth more than what you're paying. That's the essence of value investing, buying stocks for less than what they're truly worth. Value investors look for stocks that the market has overlooked or misunderstood. They believe that sooner or later, the true value of these stocks will be recognized and the price will go up. So it's all about patience and making money over the long term. The key principles of value investing. To spot these hidden gems, value investors focus on a few key principles. Intrinsic value. This is what a stock is really worth, based on factors like earnings, assets, and cash flow. Think of it as figuring out what a house is really worth before you buy it. Margin of safety. This means buying stocks for less than their intrinsic value to reduce risk. It's like wearing a seatbelt while driving, just in case something goes wrong. Long-term perspective. Value investing isn't about getting rich quick. It's about buying good companies at good prices and holding on to them for years. How to find undervalued stocks. Okay, so how do value investors actually find these undervalued stocks? They use a few key tools: price to earnings, PE ratio. This tells us how much investors are willing to pay for each dollar a company earns. A low PE might mean a stock is undervalued. Price to book, PB ratio. This compares a stock's price to the actual value of its assets. A PB ratio below 1 could signal a bargain. Free cash flow. This is the money a company has left after paying its bills. A lot of free cash flow might mean the company is in good shape. By using these tools, value investors try to figure out if a stock is selling for less than its real worth. It's kind of like checking the price of a car online before buying it at a dealership. The legends of value investing. Now let's talk about the people who turned value investing into what it is today. Benjamin Graham, known as the father of value investing, he wrote The Intelligent Investor, a book that's still a must-read for investors. Graham introduced the idea of margin of safety and taught investors to focus on the real value of companies, not just the stock price. Warren Buffett, arguably the most famous value investor of all time. He was a student of Benjamin Graham and built his fortune by buying undervalued companies with strong fundamentals. Buffett's company, Berkshire Hathaway, is worth over $700 billion today. Charlie Munger, Buffett's partner and an investing genius in his own right. He once said, "All intelligent investing is value investing," which shows just how strongly he believes in this strategy. Seth Klarman, author of Margin of Safety, a rare and valuable book in the investing world. Klarman is known for being cautious and only buying when the price is right. These investors didn't get rich overnight. They bought good companies, waited patiently, and avoided risky bets. That's the power of value investing. Why isn't everyone a value investor? If value investing works so well, why doesn't everyone do it? Well, one reason is patience. Most people want to get rich fast and chase trendy stocks instead of waiting for the market to recognize a stock's true value. Another reason is fear. When the market crashes, a lot of investors panic and sell their stocks for a loss. But value investors see these crashes as a golden opportunity to buy great companies at a discount. It's like buying winter clothes in summer when they're on clearance. Common mistakes to avoid. Before you start your value investing journey, here are some common mistakes to avoid. Falling for cheap stocks. A low price doesn't always mean a good deal. Some stocks are cheap for a reason, like companies that are losing money. Ignoring the business. Value investors don't just look at stock prices, they study the actual business. If you don't understand how a company makes money, it's probably not a good idea to invest in it. Short-term thinking. Value investing takes time. If you're not ready to hold on to stocks for years, this strategy might not be for you. Value investing versus growth investing. Now, you might have heard of growth investing. Buying stocks in companies that are expected to grow fast, even if they're expensive. So, what's the difference between growth and value investing? Value investors look for bargains and focus on what a company is worth right now. Growth investors are willing to pay higher prices if they believe a company will grow a lot in the future. Both strategies can make money, but value investing is like buying a used car that runs perfectly. You get more for less. A quick recap. Let's quickly sum it all up. Value investing is about buying stocks for less than what they're worth. using tools like the PE ratio and free cash flow to find bargains, learning from legends like Benjamin Graham and Warren Buffett, being patient and avoiding common mistakes. If you can master these principles, you might just have what it takes to be a successful value investor. And that's a wrap on value investing. If you found this video helpful, make sure to like, subscribe, and hit the bell icon for more simple investing tips. Thanks for watching, and we'll see you next time.